Today's lesson will be Chapter 2, Problem 5B. You should be able to see Chapter 22, Problem 5B. And what we're going to do today is a budgeted income statement and a budgeted balance sheet. As a preliminary to requesting budget estimates of sales, cost, and expenses for the fiscal year beginning January 1st, 2008, the following tentative trial balance as of December 31st, 2000Y7 is prepared by the accounting department of Mesa Publishing Company. And they've given you a list of accounts and their balances as of December 31st. Factory output and sales for 2000Y8 are expected to total 3,800 units of products. So these are your sales in units, which are to be sold at $120 a piece per unit. The quantities and cost of the inventories at December 31st, 2000Y8 are expected to remain unchanged from the balances at the beginning of the year. That's an important bit of information there. Budget estimates of manufacturing cost and operating expenses for the year are as follows. And so what they've done is they've broken these costs down into fixed cost and variable cost per unit here. So they've given you a list of all of the costs that they're going to be using for their budget purposes, and you're going to have to figure out how much those costs are. The balances of accounts receivable, prepaid expenses, and accounts payable at the end of the year are not expected to differ significantly from the beginning balances. The federal income tax of $35,000 on 2000Y8 taxable income will be paid during 2000Y8. Regular quarterly cash dividends of 20 cents per share are expected to be declared and paid in March, June, September, and December on 20,000 shares of common stock that are outstanding. It is anticipated that fixed assets will be purchased for $22,000 in cash in May. So what they want you to do is to prepare a budgeted income statement for the entire year 2000Y8. And on an income statement, a budgeted income statement is very similar to a external income statement that you hear. And in this one, we're going to be doing is a multi-step income statement type of budget. So we're going to start with our sales first. And what you have to do is have to figure out the total amount of the sales. And the total amount of the sales of $456,000 is determined by taking the total number of units sold during this period of time, which is right here, times the selling price of those units, which is $120. So 3,800 times $120 will give you the total sales that we start with on the income statement. Now, our cost of goods sold, if you look at your instructions here, your cost of goods sold is going to be made up of direct materials, direct labor, and factory overhead. And what we have to do is we have to find the total amount of the cost of those as expected direct materials that we're going to be using, direct labor, and the factory overhead. So we have this information about the materials, the labor, and the overhead. And you'll notice that the materials are stated in variable cost per unit sold, which is $30. So if we want to know how many units that we're anticipating that we're going to need, we would multiply that by the sales in units because that's all they gave us. See, it says variable is going to be the cost per unit sold. So $30 would be multiplied by 3,800 units that we sold that was given to us in our information. And that's how we would come up with $114,000. You might notice out to the side, I've showed you right here in parentheses how I came up with this number. Your direct labor is also going to be your units sold times the variable cost per unit for direct labor. And our variable cost per unit for direct labor was $8.40. So $8.40 times 3,800 units will give you the direct labor cost of $31,920. Your factory overhead had several types of accounts associated with it. One was the depreciation of plant and equipment. The other one was other factory overhead. For your depreciation of plant and equipment, I simply pulled off the fixed cost portion that they gave us of the depreciation, which was $4,000. Notice this time there was no variable cost associated with that depreciation. So this is probably depreciation that they used using the straight line method. It's going to be the same amount every year. And this 4,000 is the depreciation that we would be recording under factory overhead. Other factory overhead is a separate account that they're using that's also a part of factory overhead. Units sold times the variable cost per unit plus the fixed cost equals the other factory overhead. So the units sold are 3,800 units for this company. We would multiply it by the variable cost per unit for the other factory overhead, and that variable cost per unit was $4.80. So 3,800 times $4.80 plus the fixed portion of 1,400 will give you the amount of 19,640. You're going to add your depreciation of your plant and equipment plus your other factory overhead together to get the total factory overhead cost. These two are combined to get the other factory overhead, the total factory overhead cost. Once you know what the total factory overhead is, you can add it back to the direct labor and the direct materials, and that will give you your cost of goods sold. The cost of goods sold would be deducted from the sales, and that will give you your gross profit. And then we're going to look at our operating expenses. Our operating expenses are going to consist of selling expenses and administrative expenses. We're going to start with our selling expenses first. The first type of selling expenses that this company had was sales, salaries, and commissions. And this is a mixed cost, so it's got part variable and fixed cost in it. You got to figure out what the total cost is. And to do that, we're going to take the sales salaries, which is the fixed cost. We're going to add it to the variable cost, which would be calculated as the units sold times the variable cost per unit for the sales commissions in this case. So our given information tells us that our sales salaries and commission has part fixed cost in it, which would be added to the calculation of the variable cost of the commissions. So $13.50 times 38,000 units that you sold is your variable cost. And we'll add it back to the salary, which is a fixed cost, to give us the total mixed cost of $64,100. Your selling expenses also consist of advertising, and advertising is a fixed cost. So we simply pick up the amount of the advertising, which is the fixed cost of $13,200. Your miscellaneous selling expenses are going to be both fixed and variable. So the units sold times the variable cost per unit will give you the variable portion of this. So 2.5 times 3,800 units is the variable portion, plus the fixed portion of $1,000 will give you 10,500 as miscellaneous administrative expenses. Then you're simply going to add all your expenses together to get your total selling expense. The administrative expenses, there were a list of those too that you had to keep up with. Office and officer salaries are made up of both variable cost and fixed cost. So going back to the administrative expenses, the office and officer salaries, $7 times 3,800 units will give you the variable portion, plus you have to add back the 7,800 to get the total amount of the office and officer salaries for that time period. And that amount was 34,400. Your supplies also has both variable and fixed cost associated with it. So the variable portion, we take the units sold times the variable cost per unit. And this is for supplies. So 1.2 times 3,800 plus $500 is the total amount that we have for the supplies at $5,060. Your miscellaneous expense has both fixed and variable associated with it. It was $2.40 times 3,800 units sold is the variable portion of the miscellaneous administrative expense cost. Then we'd have to add back 400, which is the fixed cost portion of this, and that will give you 95.20 as the total administrative expense, or excuse me, as the total of the miscellaneous administrative expense. The total administrative expenses are all three of these separate expenses combined together. Once we know the total of the administrative expense and the total of the selling expense, we can combine them together to get the total operating expense. So these two are added up to get this 136,780. We would subtract the total operating expenses from the gross profit, and that will give you a subtitle on this income statement budget that is called income before income tax. You most likely have not seen this line item before, and this would be for a corporation because corporations have to pay income taxes. So this is the subtotal of the income that you have before you've calculated your income tax and deducted your income tax. So this is the income before income tax. The income tax expense, which is given, is subtracted from the income before income tax to get the net income for the corporation. And so that's how you do a budgeted income statement. Now, they also wanted you to do a budgeted balance sheet. And the balance sheet is basically like any other balance sheet that you've had to prepare, with the exception of down here, instead of having owner's equity, we have stockholders' equity because this is a corporation. And they sell shares of stock and this stock is called common stock. And then they have something that is called retained earnings, which is the earnings that we keep in the business that we do not distribute to our stockholders. That's what we call retained earnings. So your common stock plus your retained earnings gives you your total stockholders' equity. This part is a little bit different here, and I tried to break it down for you as best that I could, but don't worry too much about this part right here. I really want you to know that there is a thing such as a budgeted balance sheet, but I'm not going to test you on a corporation because we haven't learned about corporations yet. In this chapter, we've skipped a whole lot of chapters that we haven't covered, and we'll get to them in a later class. So if you don't understand this stockholders equity stuff here, don't worry too much about that. But what you should understand is what current assets are. These are the assets that you intend to convert to cash quickly within a year, and some current assets that we've learned about in this course are your inventories, which will be your materials, your finished goods, and your work in process inventories. All three of these are inventory accounts, and they are considered to be current assets, as well as your prepaid expenses. Now, don't worry about the cash balance here. I'm going to give you the cash balance for your homework problem, because again, we skipped a couple of chapters here, and you're not going to know how to figure the cash balance, unfortunately. So I've given you that. I made an announcement this morning earlier in class. So look at your announcements for the information for the cash account that you would be recording in Cengage. Your accounts receivable is 23,800. That was given in this problem. So if you'll go back to accounts receivable, right here it is. That's what they're expecting in the future. And the budgeted balance sheet is not exact. It's just expectations of what they think is going to happen in December. You might remember in your instructions, they said the inventories weren't going to be a whole lot of difference between them. So I just plugged in the inventory amounts. Add your inventories together, get your total inventories, and then put in your prepaid expenses, which is basically just copying what they gave you for the prepaid expense portion of this. So the first portion of the balance sheet, the current assets section, is not that difficult or not that different than anything that you've seen previously. So this is really a review for you. The budgeted balance sheet is prepared just like a regular balance sheet would be prepared. Now, the next section of the balance sheet will be the property, plant, and equipment section. And in this company, we only had plant and equipment as our property, plant, and equipment section. They gave us a beginning balance, but you have to add to it the amount purchased. And so the beginning balance of your plant and equipment is right here. And then we're going to have to add to it what they told us about in this last line of the additional information. They bought some more assets to add to it. So in this balance, it'd be 22,000 plus the 82,000 for the balance of our plant and equipment. So our plant and equipment is the beginning balance plus the amount purchased. I showed you how you would have gotten that there in this spreadsheet. The accumulated depreciation, you're going to have to take it into consideration, the beginning balance and what happened this year, and add the two together, and that will give you 36,000. So the accumulated depreciation balance was 32,000, but we added some depreciation to that for this year of $4,000. So the total amount of the accumulated depreciation is $36,000, which is deducted from the cost of the plant and equipment to get the book value of the plant and equipment of $68,000. This book value of your equipment would be added to your total current assets to get your total asset accounts. And then we would start with our liabilities. Our liabilities are going to be broken down into current liabilities and long-term liabilities. In this company, we only had current liabilities. We had accounts payable, and the amount was $14,800. And we can get that from the additional information. The account payable was $14,800. So that's where we get this $14,800. Now, again, your stockholders' equity is made up of your common stock. This amount was given. The common stock was $83,100. Nope, I picked up the wrong balance. I'm sorry. Let me try that again. Common stock is 30,000. I got off on the wrong line there. So your common stock is 30,000. I just plug that in. And retained earnings is your beginning retained earnings balance plus net income minus your dividends. That'll give you the ending retained earnings. And I figured this up for you down here where it says computations for retained earnings. This is how I got the ending retained earnings amount. But again, if you don't understand this, don't worry. This is about corporations, and we really haven't studied corporations. The dividend that is calculated in here is also here. And unfortunately, I see a mistake that I've got in here. So bear with me just a minute. Let me change this to, there's 4 months in a quarter, not 3. So that needs to be changed to 4 months. And the shares of stock outstanding times the dividends per share. Again, let me change that to where that has an asterisk there, typo error there. All right, so the shares of stock outstanding times the dividends per share will give you the dividends. And the dividends are on a monthly basis. So we have to multiply it by 4 months to get the quarterly dividends. The dividends per month is $4,000. I got that by taking 20,000 shares of common stock that was given and multiplying it by 20 cents as the dividends per share. That too was given in your instructions. And that will give you 4,000. And then 4,000 is multiplied by 4 to get the 16,000. So the 16,000 is what we used here for subtracting out the dividends. Dividends are distributions of your earnings that you pay to stockholders. It's sort of like withdrawals are. They decrease the amount of the owner's equity. So dividends will decrease the amount of the stockholders' equity. And so that's all we had to do for these 2 types of financial statement budgets. And so I'm going to stop sharing this with you. And this will be your last video for this chapter. So bye-bye.